NIO stock is taking a hit, but this isn't just a blip on the chart. Deliveries are slowing in key segments, policy pressure in China is shaking up pricing strategies, and major institutions are quietly stepping away. For investors, that's a dangerous combination if you don't know the full story. And if you're thinking about buying the dip, holding your position or cutting losses, you need to see the real numbers driving this move before you make a decision. So stick with me, hit that subscribe button, and let's break down exactly what's going on. And more importantly, what happens next. On paper, NIO delivered 21,017 vehicles in July. That might look fine at first glance, but the real story shows cracks. The flagship NIO brand delivered just 12,675 units, slipping both from last month and year over year. The rest came from the company's newer, lower-cost brands, 5,976 from Anvo and 2,366 from Firefly. Why does that matter? Because the core premium segment has always been NIO's identity. It's where the margins are supposed to be healthier. If that part of the business is shrinking while cheaper models are doing the heavy lifting, it changes the entire profitability equation. Investors aren't just looking for more cars on the road. They want the right kind of sales mix to justify a higher valuation. The Anvo L90 is the one bright spot. Launched at the very end of July, it's already showing impressive traction. Early August insurance registration data shows over 4,000 units in just 10 days. That kind of ramp-up is rare for a brand new model, and if momentum keeps up, August could see record-breaking numbers for a single NIO model. The problem? Early bursts don't always translate into sustainable growth. If demand fades after the initial wave of orders, it could leave NIO back where it started. Adding to the challenge, regulators in China have been actively discouraging extreme price wars in the auto market. That means NIO can't simply rely on aggressive discounting to pull forward demand. The company now has to prove it can compete on brand value and product quality rather than just price cuts. While deliveries are a key part of the story, the financial side tells another one. NIO is spending heavily to break into the mass market segment while still operating at a loss. That's a risky balance. It means cash burn remains a real concern, and any delay in scaling profitability makes investors nervous. The company's Go Plan strategy focuses on upgrading its theater-equivalent showrooms with premium displays, laser projection-like marketing, and more upscale touches for its cars. But these improvements require capital. This spending could pay off in the long run, but without consistent profitability, it's a gamble. Investors are essentially being asked to trust that NIO's mass market expansion will create enough scale to turn the corner financially. Until there's concrete proof in the numbers, higher gross margins, reduced cash burn, and stronger contribution from premium sales, many will stay on the sidelines. Stock performance over the past few weeks hasn't inspired much confidence. NIO has closed lower in 7 of the last 10 trading sessions, losing nearly 10% in that stretch. Rallies have been weak and short-lived, with lower trading volume on up days and heavier volume on down days. That's a classic sign of distribution, where more sellers are unloading than buyers are stepping in. The institutional data backs it up. Major holders like Citigroup, SG Americas, and IMC Chicago have all trimmed their positions, with some cuts as deep as 50%. This doesn't mean every big investor is running for the exits. There are still funds adding to their stakes, but the overall balance shows more selling pressure than buying support. In a stock already facing downward momentum, that can accelerate declines. Institutional sentiment matters because these are the players with the ability to move the price meaningfully. When they start reducing exposure, it sends a signal to the broader market, and often retail investors follow. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. It's the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. One of the last talked about factors here is the regulatory stance in China. The government has been pushing automakers to avoid disruptive price wars, aiming for healthier competition and more stable market conditions. While that sounds good in theory, it's a challenge for companies like NIO that have leaned on price incentives to drive sales in the past. Without those aggressive discounts, the company has to rely more on product appeal, brand strength, and customer loyalty to win orders. That takes time to build, and in the short term, it can slow sales momentum, especially in a competitive EV market flooded with alternatives. The key here is that if NIO can deliver strong August numbers without resorting to heavy price cuts, it would show that demand is based on product value rather than discounts. That's the kind of shift investors want to see before bidding the stock higher again. If you're holding NIO or thinking about buying in, here's how to approach the next few weeks. Watch the August delivery numbers closely, especially for the Anvo L90. If it keeps its early pace and drives total deliveries higher without eroding margins, that's a strong bullish sign. Second, pay attention to the sales mix. Growth from mass market brands is fine, but not if it comes at the cost of the premium segment's relevance. Finally, keep an eye on the upcoming earnings report. This will be the moment to see whether higher volumes are translating into better margins and less cash burn. Without progress on those fronts, even strong delivery numbers might not be enough to push the stock higher. NIO's current drop is not just about one bad month or some short-term volatility. It's a mix of delivery softness in the premium segment, regulatory changes that limit aggressive pricing, heavy spending during a period of unprofitability, and cautious institutional sentiment. The good news is that there are clear measurable signs to watch for a turnaround. August deliveries, sales mix improvements, and a positive shift in the financials. Until then, treat every rally with caution and look for confirmation before committing fresh capital. This is it for this video, guys. Thanks for watching, and please make sure to subscribe, like, and leave a comment down below.